Imagine a company operating right in the middle of a booming market. It's generating record cash flow, boasts what many call a fortress balance sheet. Sounds like a dream investment, right?
Absolutely. Ticks a lot of boxes.
But what if that company is already, well, priced for perfection, leaving very little room for error?
There's the catch.
Exactly. Today, we're diving deep into Agnico Eagle Mines, a true titan in the gold mining world. We want to uncover if its top-tier quality still translates into golden opportunities for you. Welcome to the Deep Dive. This is where we sift through, honestly, a mountain of research and reports to pull out the key insights, just for you.
Yep, cutting through the noise.
We are laser-focused today on Agnico Eagle Mines, that's AEM, their senior gold producer based up in Canada.
Right.
You'll find them trading on both the Toronto Stock Exchange and the New York Stock Exchange under that ticker, AEM.
AEM, got it.
And this is for context. As of market close on August 11th, 2025, AEM's share price on the NYSE was $135.46.
Okay, so that's our starting point.
Our mission here, really, is to unpack AEM's ability, or maybe the challenge, to convert gold's current bull market windfall into lasting shareholder value. We've got a stack of research, analyst reports. We'll guide you through the key facets.
And what's really compelling here, I think, is how AEM's core elements, its operations, its leadership, its financial discipline, they aren't just strong on their own. They're deeply interconnected. It forms a profile that genuinely stands out in the mining industry.
It's not just about riding the gold price wave, then.
No, it's about being built to capitalize on it effectively.
Okay, so let's unpack this. We've structured our deep dive into two main parts. For part one, we're going to build a solid foundation. First, we'll really try to understand AEM's core business, how it operates.
Let's get the basics down.
Then, look at the people running the show. Management's crucial here.
Always is.
And finally, we'll crunch the numbers that tell its, well, pretty credible financial story.
Yeah, and this first part, digging into those foundations, it'll really highlight the strategic choices that set Agnico Eagle apart, especially right now in this gold bull market.
Okay, let's get started. Chapter 1, Business Analysis. So, at its heart, AEM is what we call a pure-play senior gold miner.
Meaning gold is pretty much their game.
Exactly. They focus almost entirely on exploring for, developing, operating mines, and selling gold bullion. This gives you, the investor, direct exposure to the metal's price movements.
But not just gold, right? They have other metals involved.
That's right. It's not only gold. They do have significant secondary revenue streams. Think byproduct metals like silver, copper, zinc. For instance, these brought in a solid $189 million back in 2023.
Not insignificant.
Definitely not. But one of their really crucial policies, and you hear this a lot with AEM, is their no-forward gold sales policy.
And that policy, it isn't just some small detail. It's kind of Agnico's strategic superpower, especially right now.
How so?
Well, unlike a lot of their peers who hedge, lock-in prices for future production.
Right, which can cap their upside.
Precisely. AEM offers investors pure, unadulterated exposure to gold's rally. It's a bold bet, really shows confidence in where gold is headed.
Interesting point. And when it comes to production and geographic footprint, AEM is a global player, but with a very strategic focus. They produced a record 3.48 million ounces of gold in 2024.
Huge number.
And kept it strong, 866,000 ounces, roughly, in Q2 2025. But what's really key is where they operate. They deliberately focus on politically stable, low-risk jurisdictions.
We're talking Canada mainly.
Yeah, big-time Canada. Quebec, Ontario, Nunavut, plus Australia, specifically the Fosterville mine, Finland's Kittilä mine, and Mexico.
And that's a crucial differentiator. It's not just about dodging the big political headlines. It gives them stability in other ways, too.
Like what? Cost control, predictability.
Exactly. Operating in these places minimizes costly disruptions like labor disputes or sudden regulatory changes that can just wreck your cost assumptions. It builds a kind of moat around their operations.
Okay, that makes sense. And it brings us neatly to ore grade and cost trends. AEM is known for having some really high-grade mines, like Macassa in Ontario.
And high grade generally means lower costs, right? More gold per ton of rock.
Usually, yes. But even AEM isn't totally immune to inflation. They're all-in sustaining cost, the AISC.
That's the key metric everyone watches.
Right. It covers pretty much everything to keep the mines running. It has trended up a bit. It was $1,239 an ounce in 2024, and the guidance for 2025 is slightly higher, $1,250 to $1,300 an ounce.
Still very competitive, though, in the grand scheme of things.
Absolutely. We'll get to that comparison later. But speaking of long-term, their reserve life index. This is really exceptional.
Yeah, I saw the numbers. Pretty staggering.
At the end of 2024, they reported 54.3 million ounces of proven and probable gold reserves.
54 million ounces. Wow.
Based on their current production rate, that translates to a nearly 16-year reserve life index. 16 years.
That kind of visibility, that future production certainty, it's incredibly rare in this industry. It gives them a really long runway. Analysts love that.
Definitely a core strength. So it's clear AEM is operating in a very favorable environment for gold itself. Let's touch on the industry analysis. A bull market for gold.
Well, yeah, gold recently hit a 5-year high, didn't it? Over $3,400 an ounce.
$3,454.70 was the peak. It's currently trading around $3,400. And this surge, it seems to be fueled by a few key things.
Like central banks buying.
Historic central bank demand, absolutely. They're diversifying away from traditional currencies, plus strong investment demand driven by, geopolitical tensions, inflation concerns.
And the simple fact that you can't just flip a switch and get more gold mines online.
Right. Global mine supply is pretty inelastic. It takes years and billions to develop a new mine.
But it's not all smooth sailing for miners, even in a bull market. Costs are a real challenge.
Definitely. Inflation is hitting labor, energy, environmental compliance. And there's increasing pressure for higher ESG standards. Environmental, social governance.
Yeah, ESG isn't just a nice to have anymore. It impacts your license to operate, your access to capital. It's crucial.
Which brings us back to Agnico Eagle's competitive advantage best-in-class operations. Their moat. It's not just about the gold itself. It's how efficiently they get it out. Their cost structure and operational excellence.
So let's talk cost leadership.
Okay. Q2 2025, their AISC was $12,289 an ounce. Now compare that. Newmont was at $1,593. Barrick Gold was $1,775 in Q1.
Wow, that's a significant gap. Hundreds of dollars per ounce.
It really is, and it positions them consistently at the very low end of the cost curve.
And that's not just luck, right? It comes back to those high-quality assets and the stable jurisdictions we talked about.
Exactly. Less disruption, more predictability. It might cost more upfront sometimes to operate there, but it pays off over the long run in stable, low costs.
Makes sense. And their specific assets.
Their unique assets and capabilities are key, too. They have this portfolio of large, long-life, high-quality deposits. Think Lorand, Detour Lake, which came with that Kirkland Lake merger, Fosterville down in Australia.
World-class assets.
Absolutely. Plus, they have a really strong exploration team with a proven track record of finding more gold, replacing what they mine, and actually growing reserves. That secures the future. All right, let's shift gears now. Chapter 2, Management Evaluation. Because, a great set of assets is one thing, but you need the right people steering the ship.
Couldn't agree more. Leadership is paramount in mining.
So, leadership assessment, a legacy of discipline and vision. You have to start with Sean Boyd. He was CEO from 1998 right up to 2022, and he's now chairman.
He really built the modern Agnico Eagle.
Absolutely. Transformed it from a pretty small operator into this global leader. Market cap went from like $400 million to over $55 billion under his watch. His focus was always on per-share value, operational excellence, community relations. Laid a really strong foundation.
And the current CEO, Amar Al-Jondi, he's no slouch either.
No, a seasoned veteran. He was president and CFO at AEM before taking the top job in 2022. But interestingly, he was also CFO at Barrick Gold, a major competitor.
Oh, that's interesting. So he brings that external perspective, too.
Exactly. Deep internal knowledge, plus insights from a key rival. It's a powerful combination. Visionary chairman, operationally sharp CEO.
And that discipline really shows in how they handle their money, doesn't it?
It really does. Let's talk capital allocation, a masterclass in a bull market. The mining industry, historically, it's terrible for this.
Yeah, notorious for overpaying for acquisitions when prices are high, burning cash.
Right. But AEM seems to be breaking that mold. Q2 2025, they generated a stunning $1.3 billion in free cash flow, just in one quarter.
So what do they do with it? That's the key question.
Well, this is where the masterclass part comes in. Instead of immediately chasing some mega deal, they prioritized financial strength first. $550 million went straight to paying down debt.
Which pushed them into a net cash position, right? Nearly $1 billion.
Exactly. $963 million net cash. Then they returned cash to shareholders. $200 million in dividends, $100 million in stock buyback.
While still investing in their own projects.
Yes. Still funding organic growth at places like Detour Lake, Canadian Malartic, Upper Beaver, And their M&A has been disciplined too. That 2022 merger of equals with Kirkland Lake Gold was widely seen as smart, adding great assets and synergies.
That focus on discipline and returns is rare. It really stands out.
And you see it in shareholder returns and ROIC. They've paid a cash dividend every single year since 1983.
Over 40 years. That's incredible consistency.
It is. The current quarterly dividend is $0.40 a share. Plus, they've got a U.S. $1 billion share buyback authorization from May 2025.
Shows commitment to returning capital.
Yeah.
And the ROIC, return on invested capital.
Yeah, that dipped a bit in 2022, right after the Kirkland Lake merger, down to about 4.5%. But it's recovered strongly since then. The latest trailing 12 months figure is 12.61%.
So demonstrating that the merger and their investments are actually creating value.
Pretty clear evidence, yeah. Okay, let's really get into the numbers now. Chapter 3, financial analysis. Because Agnico Eagle's financials are, well, exceptionally strong. Let's do a key metrics review. Financial fortress. Market cap is hovering around $68.2 billion.
Big company.
Huge. And revenue growth. It's been absolutely blistering.
Yeah.
Went from $3.1 billion in 2020 up to $8.3 billion in 2024.
Nearly tripled.
Yeah. And the trailing 12 months revenue as of Q2 2025 is $9.66 billion, almost hitting that $10 billion mark annually.
And you connect that revenue growth to their low costs and the high gold price. Margins must be looking pretty good.
Very healthy. TTM gross margin 68%, operating margin over 47%. Net profit margin over 30%. These are strong numbers.
But the real powerhouse is that free cash flow generation we touched on.
Absolutely. That record $1.3 billion in Q2 25 alone. For the full year 2024, it was $2.14 billion.
And that massive cash flow is what fuels everything else, the debt repayment, the dividends, the buybacks, the growth projects. It's the engine.
Totally. And it all feeds into their financial stability. A rock-solid balance sheet. In mining, which is so cyclical, this is just essential.
Peace of mind for investors.
Definitely. Their debt-to-equity ratio. Tiny, like 0.006.
Practically no debt relative to equity.
And after that big debt repayment in Q2, they're in that net cash position we mentioned, $963 million. Cash exceeds total debt.
Incredible strength. And liquidity.
Also very strong. Current ratio is 2.37. So current assets cover current liabilities more than 2 times over. Plus, that 40-plus year dividend streak speaks volumes about stability.
Okay, so financially, they look impeccable. But how does the market value this quality?
That's the million-dollar question, isn't it? This brings us to valuation analysis. Paying a premium for quality. The market definitely recognizes AEM's quality, and is reflected in premium valuation multiples.
So compared to their peers?
Yeah, looking at relative valuation, AEM's TTM/PE ratio is around 22.9, and its price to cash flow is about 14.5. Both are noticeably higher than competitors like Newmont or Barrick Gold.
Meaning the market's willing to pay more for AEM's lower risk, better costs, stronger balance sheet, all the things we've discussed.
Pretty much, yeah. It's a premium for quality and perceived safety. Now, intrinsic valuation, trying to figure out what it's really worth, that gets trickier.
Because it depends heavily on your assumptions, especially about future gold prices.
Exactly. You see a wide range of estimates. Morningstar, for example, has a fair value estimate of just $66 per share.
Which suggests it's way overvalued right now.
Right. But then you look at Investing.com's consensus, which averages 14 different analyst models, and their fair value is $139.90.
Very close to the current price.
It really highlights how sensitive these models are to that long-term gold price assumption. Different views on gold lead to wildly different valuations.
And sector-specific metrics, like price to NAV.
Good point. Looking at sector-specific metrics, AEM trades at about 1.1 times its price to net asset value, PNAV. That's a premium to the peer average, which is closer to 0.8x.
So again, valued higher than its peers based on its assets.
Yep. And its enterprise value per ounce of reserves is around $1,240. These numbers just reinforce that story. The market sees AEM as top tier and assigns it a premium valuation. Okay, here's where it gets really interesting, I think. We've laid out the foundations, the business, the management, the financials. Now let's explore how the market sees AEM, who actually owns the stock, the potential pitfalls, the risks.
Yeah, connecting it to the bigger picture.
And ultimately, what does all this mean for you, the listener?
Right. Because understanding those external perceptions and the inherent risks is absolutely crucial, especially when you're looking at a company that's already highly valued, like Agnico Eagle.
Yeah.
It's about weighing that recognized quality against what could potentially go wrong.
Let's dive into part 2, chapter 4, market sentiment. So how does Wall Street feel about AEM? Overwhelmingly positive, it seems. Looking at market perception, a Wall Street favorite, the consensus rating among the 15 analysts covering the stock is a strong buy.
Strong buy. That's pretty decisive.
It is. 10 analysts rate it strong buy, 3 say buy, and only 2 are neutral or negative. The average 12-month price target is $142.56.
Okay, so suggesting some modest upside from the current $135 level.
Yeah, but the range is wide. Lowest target is about $110, highest is up at 173 cents. Again, reflecting those different gold price outlooks.
And earnings expectations. Are analysts bullish there too?
Seems so. Q3 2025 EPS forecast is $1.63, and analysts have been consistently revising their full-year 2025 estimates upward. That signals growing confidence in their performance.
Okay, so sentiment is positive. What about market indicators, technicals, short interest?
Good question. Under market indicators, technical strength and low bearish bets, we see very few people betting against the stock. Short interest is minimal, only 1.63% of the public float.
So not many bears out there.
Not really. And technically, the stock's in a strong, sustained uptrend. The current price, $135.46, is well above both its 50-day moving average, which is around $122, and its 200-day average, down near $102.
And you've got that golden cross pattern too, right? 50-day above the 200-day.
Yeah, the 50-day crossed above the 200-day, which technicians see as a classic bullish signal.
Okay, so lots of positive signals. But what's the flip side?
Well, the implication of all this positivity and the strong technical picture is that expectations are incredibly high. The market seems to have priced in continued flawless execution and a strong gold price.
Which means the margin for error is pretty thin.
Exactly. Any disappointment, operational hiccup, costs coming in higher, or crucially, a drop in the gold price could lead to an outsized negative reaction in the share price. Okay, let's move on. Chapter 5. Ownership structure. Who actually owns Agnico Eagle shares? A stakeholder analysis, institutionally owned and approved, reveals it's dominated by big players.
Institutions, right, like mutual funds, pension funds.
Yep, approximately 73% of the shares are held by institutions. That high level signals strong confidence from the professional investment community. They've bought into the story.
Any big names among the top holders?
Oh yeah. The top holders include BlackRock, with about 5.8%, FMR LLC, that's Fidelity, with 4.1%, and Van Eck Associates, known for their gold ETFs, holding about 4.0%.
Okay, so heavily endorsed by the big money managers. What about retail and insiders?
Retail investors hold a balance, around 26%. Insider ownership, meaning management and the board, is less than 1%. That's pretty typical for a large, mature company like this.
Right. And speaking of insiders.
Ah, yes. Insider holdings and recent transactions. Looking at recent filings from mid-2025, we did see several senior officers selling shares.
Oh, how much?
Well, one example, an officer sold 5,000 shares for around $852,000. Another sold over 11,900 shares for more than $2 million.
So should investors see that as a red flag, insider selling?
It's a fair question, but context is crucial here.
Yeah.
Remember, the stock has had a massive run-up. The market cap increased something like 87% in the past year.
Right, huge appreciation.
So for executives whose compensation is heavily weighted towards stock, it's often just prudent personal financial management to diversify a bit after such big gains. Lock in some profits, rebalance their own portfolios.
So likely pre-planned sales or diversification, not necessarily a loss of faith in the company.
That's how it looks. It doesn't seem panicked or widespread. More likely part of regular financial planning, rather than a signal that they think the stock is peaking. Okay, let's get into the risks. Chapter 6. Risk assessment. Because no investment is without risk, right? A good way to frame this is a SWOT analysis. Strengths, weaknesses, opportunities, threats.
Okay, let's break it down. Strengths first.
We've covered these pretty well. Industry-leading low AISC, that fortress balance sheet with net cash, the incredibly long reserve life, around 16 years, high-quality assets in safe, low-risk jurisdictions, and experienced discipline management.
Very strong foundation. What about weaknesses?
The main one we keep coming back to is that premium valuation. It's price for quality, which inherently limits the potential upside from here.
Right, a lot of the good news might already be in the price.
Exactly. Also, their production profile is expected to be relatively flat for the next couple of years, 2025 through 2027. And of course, the big one, high sensitivity to the gold price. Their fortunes are tied to it.
Okay, weakness is noted. What about opportunities?
There are definitely significant ones. They have huge production growth potential coming from their deep project pipeline, but that's more post-2027. They could potentially hit over 4 million ounces annually by 2032.
So longer-term growth story.
Yes. Plus, continued success in exploration is always an opportunity. The favorable macro environment, persistent inflation, geopolitical tensions that helps gold, helps AEM, and there's always potential for more smart, value-adding M&A.
Makes sense. And finally, the threats.
The biggest single threat, no question, is a significant decline in the gold price. That would hit them hard, especially with the premium valuation.
Execution risk too, right, on those big development projects.
Absolutely. Cost overruns or delays are always a risk in mining. Escalating input costs, labor, energy remain a threat. And even in safe jurisdictions, you face geopolitical risks like permitting delays or disruptive trade policies.
Which brings us to that specific example you mentioned.
Right. The impact of specific geopolitical factors, like the U.S. tariffs of 2025. There was that period in mid-2025 where the market got really nervous about potential U.S. tariffs on gold bars.
Even though gold wasn't ultimately tariffed.
Correct, but it highlighted the vulnerability. Even for a Canadian producer like AEM, operating in supposedly safe jurisdictions, sudden policy shifts elsewhere can create turmoil.
It really underscores that global interconnectedness. Geopolitical risk is never truly zero, even if you choose your locations carefully. It shows how sensitive the whole supply chain can be.
All right, let's wrap this all up. Chapter 7. Conclusion. Time for a synthesis of findings. What have we learned? Agnico Eagle Mines is undeniably a premier operator, truly best in class in the gold sector.
No question about the quality.
But that quality comes at a price. The investment case really boils down to two competing narratives, doesn't it? The bull versus the bear.
Let's hear the bull case first.
The bull case rests squarely on that best-in-class status. Superior, long-life assets in the safest places, industry-leading low costs, massive free cash flow generation.
Managed by a disciplined team returning cash and investing smartly.
Exactly. Strong balance sheet, consistent shareholder returns, and that deep organic growth pipeline for the future. If you want high-quality, lower-risk gold exposure, AEM is often seen as the top choice.
Okay, makes sense. Now the bear case.
The bear case doesn't really argue with the quality. Instead, it focuses on the valuation and that dependence on gold. The argument is AEM's strengths are well-known, maybe too well-known.
Already fully priced in, leaving a little margin of safety.
Pretty much. Its fortunes are just inextricably linked to the volatile gold price. If gold takes a significant downturn, AEM stock, with its premium valuation, could correct sharply.
And execution risk on those growth plans is also a factor. Any slip-ups could disappoint investors.
Right, so looking at our valuation summary and concluding outlook. Current share price, $135.46. We saw that wide range of intrinsic value estimates. Morningstar down to $66. Investing.com consensus, near $140.
So depending on your gold view, it's either way overvalued or roughly fairly valued?
Exactly. An investment in AEM today is really a bet on continued excellence and a strong gold market. You're paying that premium for quality, for safety, and for superior management.
Okay, so how might things play out? What are the scenarios?
We see three primary scenarios. First, the base case. Gold prices stay relatively stable, maybe $3,400 an ounce. AEM meets its guidance, 3.4 million ounces, AISC around $1,275.
In that case, the stock probably trades sideways. Performance already priced in.
Likely, yeah. Then the bull case. Imagine gold surges, hits $4,000 or higher. Maybe geopolitical issues escalate. Inflation stays stubbornly high. At the same time, AEM successfully de-risks its pipeline, shows a clear path to 4 million plus ounces.
Higher earnings, plus maybe an even higher valuation multiple.
That could mean new all-time highs for the stock. Now, the bear case. What if gold corrects? Maybe global tensions ease. Inflation falls faster than expected. Gold drops back towards $2,500.
And what if that's compounded by an operational issue at AEM? A project delay?
Then the stock's premium valuation would likely contract sharply. You could see significant downside in that scenario.
So quality is clear, but the outcome really hinges on execution and the gold price.
That's the crux of it. Agnico Eagle Mines offers unparalleled quality in the gold sector, but its current valuation asks you, the listener, a crucial question. Are you willing to pay that premium for perfection, believing the quality and gold price will hold up? Or does the dependence on the unpredictable price of gold introduce a risk that even best-in-class management can't fully mitigate?
A key question for anyone considering an investment.
Indeed, something to think about. And if you found this deep dive valuable, please do like and subscribe to the Untroyon's YouTube channel. We'll be covering all mining companies, and we definitely welcome your stock suggestions for future videos. Just drop them in the comments.
Yes, please do. Now, just the usual reminders. This analysis was generated by an AI system for educational purposes only. It should absolutely not be considered financial advice.
That's right. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.
And also, the research for this deep dive was supported by an AI system to process the, frankly, extensive source material, ensuring we could thoroughly and efficiently extract the key insights for you today.
Thanks for joining us on the deep dive.